Welcome to the second of our Women's Series webinars. This webinar will run for approximately 1 hour and contains general advice. The topic for today's webinar is rebuilding after divorce. And today you will receive award-winning information from Shannon Smit, Financial Advisor and winner of Women in Finance Financial Advisor of the Year 2021 and IFA Goals Based Adviser of the Year 2021. Our team presenting today is Shannon and myself. My name is Bianca. I'm a Paraplanner at Smart Business Solutions, and I'll be your moderator today. We do have time for questions at the end of this session, so please submit your questions through in the Q&A box at the bottom of your screen, either during the meeting or towards the end of the meeting, and we will go through your questions and answer those. For this session, you should automatically be placed on mute, or if not, could you please make sure that you are placed on mute. And our main presenter today is Shannon Smit, Founder and Managing Director of Smart Business Solutions and Smart Financial Planning. Shannon is a qualified accountant and financial advisor, and Shannon has been advising small and large businesses for over 25 years. And prior to founding Smart Business Solutions 14 years ago, or almost 15 years ago, worked for one of the world's leading accounting firms in Melbourne, Prague, Amsterdam, and New York. Shannon is an expert in goals-based financial advice, self-managed superannuation funds, and retirement planning. And also to introduce our financial planning team. So these are some of the faces that you may speak to over the phone. And one moment, just to go through the important information that this recording webinar contains general advice. It does not take into account your personal objectives or financial situations or needs. So you should consider speaking to a financial professional when making a financial decision. And so to welcome Shannon.
Right. Thanks very much, Bianca, and thanks everyone for joining us. We've got quite a lot of interest today, so I look forward to going through this as well. And feel free afterwards also to, we will email out the slides and also the recording as well. So if there's anything that you've missed and you want to go through in a bit more detail, we can do that. So today what I really want to talk about is how we're looking at rebuilding post-divorce. Now, if you are about to go in early stages of divorce or going through that process, you might want to have a look, and we can share with you on our YouTube an accounting and tax aspect of going through divorce and things that you need to think about. So do reach out to us if you need some further assistance on that side. But what I really wanted to talk about today is moving on financially after divorce. And given the unfortunate high rate of divorce, chances are most of us know someone who is going through divorce, or maybe it's yourself and others, and have probably seen the financial implications of going through that at the moment as well. You also need to, as going through that process, adjusting to a new standard or difference in the way in which you're living. Things are changing. And I guess what we've really found is that when we look back at the situations of women and coming out of post-divorce, the financial outcomes that we've seen and I've experienced, and is kind of one of the triggers for actually pulling together this webinar, is often, more often than not, has been the lack of being involved in some of the financials earlier, and the overwhelming situation they're facing themselves in being now responsible on the financial aspect. So what I want to go through today is really looking at goals, thinking big, how to set up a spending and investment plan. And what do I mean by that? What's an emergency fund, and how much do you need? What can you do? And then think about your insurances and understand some of the fine print. I think that's something that's often overlooked and becomes all of a sudden quite critical. And then looking at your superannuation, your will, and protecting your assets. So really touching on all the different financial aspects to really help you in this post-divorce situation that you're finding yourself in. So it is a time where you've got a lot of changes. It is an opportunity, new life, new goals, and really an opportunity to think big and start to actually look at it. And probably like many women, we all don't think about ourselves. All of a sudden, we put everyone in front of our needs, especially the kids as well, and things in those scenarios. So when you may have got married, you had your financial goals that you set together with your spouse, but now you're starting a new life. So a great way to move forward is to really set new financial goals about yourself. And as you're setting these financial goals, really start to ask yourself, what is the life that you want, and what's that going to look like in 1 year, 5 years, and 10 years from now? I know in coming through this divorce situation, I see this with many of my clients. It's a stressful period, and getting through that situation, that it's really hard to think about what does 1 year look like, 2 year, 5 year, 10 year, but start to putting those goals out and what you would like to accomplish to actually have you living, that as they often say at the moment, this best life. And it may sound like a cliche, but really starting to try and think what some of those are, and look at some of your, whether it be financial goals, but also the emotion side of things do matter. And for those of you that joined our first series, and if you did the first webinar, if you missed that, do go back and have a look. I talked about the three buckets, which I kind of put into teacups, and where your finances are sitting, but also about where your goals need to be looking at a balancing act. So when you're thinking about these goals, think about what do you want emotionally and personally, and then we like to align those with clients to look at, well, what might be some of the tax outcomes on these goals, what might be some of the financial outcomes on these goals, but making sure you're actually satisfying what are your personal goals from a long-term perspective. Something can be a bad tax outcome, a bad financial outcome, but satisfy those goals and those whole reasons for living. So really take this as an opportunity to say, what are these goals going to be? And once you've got these goals, when you're looking at from a financial perspective, is starting to look at spending, setting up a spending and investment plan. So I've got a few key steps to do that. And I know that there's many of my clients do not love accounting as much as I do. And I understand that part, but really trying to get engaged with your financial position, I can really assure you, you are going to be so empowered and probably really proud of yourself as well when you start to look at this. But it gives you some control back. Maybe you haven't had that feeling of control in your financial situation. Divorce, there's probably been things throwing back and forth on a financial aspect. So really starting to try and get yourself to be able to put some control back, that you are in control of your finances and it's your situation now. So look at creating a monthly budget. So chances are, your household and income and expenses, it's going to look different post-divorce. So some of you may be actually budgeting for the very first time. So create your budget. First document, what's your monthly income? What is the income that you know that you're going to be getting on a monthly basis? And what are the expenses? Some of the expenses may be higher now that you haven't got that being in a sense shared from that perspective. You may be moving to a new home. Some of your expenses may be lower as a result of just having yourself and not having the two of you. But start to have a think about what's the income that I have, and what are the known expenses that I have to spend on, and what are some of the things that I want to spend on? I call that for sanity. You want to make sure you're still engaging and going out, and trying to actually then look at putting this budget together and then trying to look at tracking that. Now, maybe tracking it isn't the excitement for most people, but trying to track it maybe even for a shorter period of time to try and work out where are you spending some of this money. And during this period, you've got a lot of period of change going on to try and understand really what's going to be needed. Now, I did talk in our first session a lot more about creating a personal budget and expenses, so that our first webinar does go in a bit more detail, but this is so critical post-divorce to actually have a look at what does my new world look like. So you've thought of some of your goals, but how do I achieve those goals? Because a lot of our goals do unfortunately need some financial element to help us achieve those goals. So what's your income? What are your known expenses? And then what might be some of the kind of variable expenses or expenses that might change at different months? You might want to go on a holiday and some of these other goals. Now, another really good one to do, and this is really to help put a line in the sand, is to actually start to say, well, let me calculate my net worth. What am I worth? Where is that at the moment? What are my assets worth? So what do I own? what do I owe? What, maybe it's a mortgage, and really trying to say, well, what is my net worth? And I really like putting that line in the sand, because it starts to give you an idea that there's often I see when couples go through divorce, unfortunately, there's really one big winner out of it, and that's the lawyer, unfortunately, is what I often tend to see. So the asset base does get eroded from that perspective. But what we want to look at is rebuilding your life post-divorce, but rebuilding your net worth and really trying to understand what is it that you're actually, where's your starting point, and start tracking that. That can actually also give you some good, I find it empowering for clients to actually see how their net worth is changing, but that line in the sand and looking at it so that you know what are those debts that you owe, so that is one of my other steps in a second that we can start looking at. But put that on. And as I'm saying, when I talk about these different areas, it doesn't have to be a glamorous document. We have a few templates. It doesn't have to be anything fancy, but by writing it down, I often find myself, if I write something down, it helps me actually kind of put it in motion and get that goal out there and get that information there. The next one is to look at, so you have actually put together on your income, you've got expenses, but to potentially have a look and reduce or eliminate some of those household expenses. If we're looking at if your household income has decreased as a result of your divorce, and I was working with someone yesterday that, the income's gone down, what expenses do we need to keep, and what expenses can we eliminate potentially to look at, to give them a position of being able to financially bounce back from that situation. Now, that may change over time. And again, as I talked about in my first webinar, this is a balancing act. This is not about just not spending any money and staying at home, because that's not going to be great for your emotional well-being, but it's a balancing act to try and ensure that finance doesn't become a burden for you as you're actually in this bouncing back period. I want finance to become something that you feel really empowered and on top of, and I get really excited when I'm working with women that kind of come back, come out of rebound after divorce and really actually become this better person than they ever were before, more in control and more empowered with what their financial position is. So looking through your expenses, I always say needs and wants. There's a lot of things that we want. It may not be a need, and that may be at this period of time something that you may need to adjust just to help you, look at it. It may even be refinancing, maybe a car loan. Can you refinance, incorporate that potentially into your home mortgage? Would that give you a better interest rate? Maybe it's selling it and buying a more affordable one so that you can live more comfortably at this point in time. But really going through your expenses and trying to understand what is a need and a want, and to enable you to help balance that budget as well. When we go through this, it's also looking at, well, what are the debts that you have in place now as a result of post-divorce? Do you have any debts in place, any mortgage, maybe car finance? And what's our plan to be able to pay off those debts? Or is there a plan? And I had this in a discussion with a client yesterday. This is where you can have decisions going back to my balancing act of, what's a great tax outcome, what's a great financial outcome, and what's just a great personal financial goal that you need a personal goal that's going to help satisfy your life. If you've got young children, whilst all of us would love to pay off our home loan really quickly and have that paid off, that may not be the overall best outcome for you. If you've got young children, and to enable you to pay off that debt really quickly means no holidays, no going out, and you're just staying at home for the next X number of years. Now, that might mean that you pay off your debt really quickly, but you haven't been able to live and enjoy the time with your children. So looking at your overall debt, looking at your budget of your income, looking at your expenses, and financially modelling that out. I work with clients to financially model that out and say, well, look, maybe if you didn't pay off your home loan in this period of time, and instead you paid it off over this longer period of time, this will actually enable you to do the holiday here and there with your kids, do the caravanning, maybe do a Disneyland trip. And so you've got to live as well. And it's knowing, I had one client that we've been working with lately that really wants to pay off their home loan ASAP, but actually doing the financial scenario modelling and being able to say, well, here's where you would be if you paid it off in every spare cent you had and you didn't get to live, quite frankly. And here's where you would be if you got to enjoy your life and actually enjoy with the kids while they're younger, it's going to take you this many years longer to be able to be in a position to pay that loan off. And now they're comfortable with that. They're like, okay, I have a plan. I know my home loan will be paid off before that age, and I'm okay with that. And I'm going to enjoy this time with my kids. And I've planned in the holidays that I'm going to do with them and be able to do that. So it's really trying to look at ways of getting you in a position where it is that empowerment and control of being able to balance the debt with trying to live, because all of a sudden you are being in a position of juggling a lot of different balls from that. But at the end of the day, you need to plan to pay off your debt, to get that done so it's not a burden and not a stress for you on that side. Now, there may be some situations, I haven't seen it with everyone, but I raise it because it has happened. I've often seen when divorces get a bit bitter, people stop paying back mortgages, stop paying credit cards, and all of a sudden your credit history has gone as a result of that. And that's been through the dispute and going through the divorce. Maybe you didn't have access to the funding to pay off that, but somehow your credit history has actually been impacted on that. So it is worth actually having a check of your credit history to see how has that gone if you've had some of those types of challenges during the period of divorce, so that you can really work on rebuilding that credit, so that when you need it or want it, you have that choice and ability to be able to do that. Some of the things, just some little tips which will help increase your credit score, just always making sure that you pay those your monthly payments on time, whether it needs a reminder, auto direct debit, some of those, because even if it's a day or two late, can actually, maybe you don't end up paying interest on something with the day or two late. It actually adds, if you've already got a negative credit score, it just keeps adding to that negative credit score. Where possible, keep your credit utilization, they say below 30%. So your available credit, and you've kept it below the 30%. And do have a look at your full credit report. It's the rebuilding your credit has been something that I've often seen that's become as a surprise to many clients as they're trying to rebuild. They're rebuilding their life, they're getting their income, their expenses going, and then they want to, whether it be to buy a house or go to that next level, and they discover at that point their credit history was kind of ruined during that divorce period. So it's worth knowing what you're dealing with, knowing where you're at, so that you can actually then proactively plan as to how are you going to rebuild that. So when you want it or you need it, you've got to the other side as well from that perspective. So one thing that I really like to stress to my clients when we're coming out of this, the last thing you're probably thinking of in coming out of divorce with all of these finances is an emergency fund. And maybe you don't have that those spare funds at the moment, but really trying to think, you want to start building up this emergency fund. This actually helps really empower you to ensure that you've got those funds and that you're not constantly stressing about money. So an emergency fund is basically money to cover all those urgent, unexpected, hot water service blows up, the car dies, all of those things that you're not expecting to happen, and is going to really strain you from that perspective. So I often look at saying, look, start building, and it can be as low as you want, but it kind of gives you that financial safety net, so you don't have to borrow if things happen to you or your family, and really to try and think about, how can I start that emergency fund and at least get it going. So how much do you actually need? Look, for many people, what I do find, divorce does wipe out all or a lot of their savings, depending on the situation. I mean, sometimes, and as I said before, unfortunately, often the lawyers are the ones that do get the positive out of divorce, so to speak. So one of the financial priorities, just look at rebuilding this fund. I say it's a good rule of thumb, and look, a lot of us learned this through COVID, and I saw this with a number of people. Probably since when I was younger, my parents used to always say, you must have at least 3 to 6 months of your expenses in your emergency fund. That does seem a lot. Now, the 6 months does seem a lot, but what we all learned in that COVID period, and businesses learned this from the first time ever, that their doors were shut, no income was coming in, and that the expenses continued. So really trying to build yourself up to this 3 to 6 months. That doesn't mean you need to do that in a very short period of time. I've got some clients where we're on a 2-year plan to get to that 3-month level, because we're just taking a bit out each month to build that up. Now, when I say, how do we do that? we start I ideally say setting up, say, a separate savings account. So automate your savings so that the money is automatically going into that. Now, you know that if the whole water service blows up, you can grab that money out, but it's been taken out of your main account into a savings account. You're less likely to spend it on something else, and it's out of sight, out of mind. Maximise if you do have a home loan and you have an offset account, you actually may use that as your emergency fund, because then you're reducing your interest as well. And again, automatically take that amount out and put it, and just keep adding to your emergency fund. A really good opportunity with your emergency fund, if you happen to get some additional funds, maybe it's a tax refund or something like that. If maybe I've seen a number of clients, even when they've actually had a bonus or a pay increase, being able to say, well, actually, I didn't have that before, so let me do an auto direct debit for that amount. Let me still keep living on the funds that I've been living on and put that amount. And once I get my emergency fund up to this exact dollar amount, then I'm going to start moving forward and start using those funds for other things that they may be looking at using. So really trying to set yourself up to have what I would say is this safety blanket, so that you can feel comfort that when you do have these issues, you're going to have enough going on in your life with all these other stresses, that if that hot water service does blow up, you've built up your emergency fund to enable you to be in a position to pay for it. Not great, but to be able to then move on and not get stressed as to where those funds are going to be coming from. Now, one thing I often see, a lot of people forget to review their insurances. Now, the reason I highlight this, and you think divorce and insurances, why are we putting that together? But now there are four main types of insurances, and I think this often gets overlooked. Now, obviously, from a beneficiary perspective, I say from life insurance, who gets your life insurance? You probably don't want your ex-spouse to be getting that. So if I look at the four different types of insurances, so we have life insurance. So life insurance is paid as a lump sum when you pass away. And so that would be something that looking at, well, what if something happened to me tomorrow? What would I like the insurance company to pay to my kids, and how would I like that to be done? What would I like to be paid off? And so life insurance is really looking at that lump sum. It's basically usually owned by, my recommendation is always looking at it owned by your super fund, which is either your industry fund, your retail fund, or if you have a self-managed super, but owned by the super fund and payable by through your super. TPD, so that's totally permanently disabled. So something has happened to you that you are now totally permanently disabled. Who pays for things? Who supports you without you ideally having you avoid a situation on going on to potentially a government pension, which would be, as we know with a lot of the government pensions, quite bare needs getting by. So TPD is also an insurance that you would have your super fund own as well and get paid from your super. I'll talk in the next slide about what kind of balances are we looking at, but thinking about those ones. Now, what does become really, really important when you are post-divorce is income protection, because all of a sudden you don't have two of you, that if something happened to one of you and you weren't able to work for a few months, you may have other income coming into the household. What would happen, and this is where I find a lot of women are more vulnerable at this situation, what would happen if your income stopped? Something happened to you and you weren't able to work for a period of time, whether it be 30 days, 60 days, 90 days, or what is that period of time? You may have a lot of annual leave owing from your company. You may have a lot of personal leave as well. So that will kind of, I guess, dictate as to how much time is it. But having to think about on income protection, what would happen now? I look at it, and if you are well established, you may be less reliant. If I couldn't work for 6 months, if I couldn't work for 12 months or longer, I would be comfortable. If you've got young children, in a situation where you've got young children and you've got a lot of costs coming and you're heavily reliant on your income, I would be looking at the income protection. And even if you go into an income protection, isn't the cheapest of insurances. I'll be the first to say that. It's the risk that you want the insurance company to take so that you don't have that risk. I'd be looking at to even potentially saying it may be something that you go into saying the next 5 years is absolutely critical for me to maintain my income. And if something was to happen, I would be in a very unfortunate position. So that makes something that you would
make sure
that seems to be back.
My screen dropped out, sorry.
Okay, is that picked up? Okay, so back on. So that might be something that you might say, well, look, I'm going to invest in the income protection just for this short period of time, whilst it's really critical for your personal situation. Then we have recovery or trauma insurance. Now, trauma is, and they say 1 in 3 Australians will have a trauma event. So it's like a breast cancer, heart attack. And they often look at the scenario of it being an event that's probably like a 2-year period. You may be, in a sense, out of action. Now, we look at trauma insurance in conjunction with income protection, so that if there's income still coming in, but trauma is a lump sum payout that is received. So if something happens to you, there is a lump sum to help you get through that period as well. But worth thinking about your insurances. It may be something you've never actually looked at. Many of you will probably have life and TPD. If you've never looked at insurances, your super funds that you've probably signed up a very long time ago through work and they've just been ticking on, most likely they will have life and TPD. They may have income protection in it. Now, here's a quick tip for you. I personally do not like income protection in superannuation. Why? You might be eligible to that income protection because you something happened to you, and yes, you're eligible, but it's in super and you are not at preservation age and you're not at severe hardship. You can't access it. So your super fund's getting the income protection, but you can't use it until you're over 60. So that's something that a lot of the retail funds just put in as I could nearly say, a very small, you're paying for it, but a little small amount on the income protection. So it's worth just having a look for this period of time, just to make sure that you've got yourself covered from that. So when we talk insurances, what's available, what do you actually need? So what you're actually saying to the insurance company is, if something happens to me, I want you to cover these things because I want that to be your risk and I'm going to pay your premium for that. There may be some parts that you're happy to self-insure. Income protection, for example, you might say, look, if I didn't have any income for 90 days, it wouldn't be great, but I would survive. So, and if you had your emergency fund built up, that may be an option. So if your insurance for income protection doesn't start for 90 days, then your insurance is going to be cheaper than income protection that starts up to 30 days. So there's some of those little variables, but you're looking at what would be important to you, that if something was to happen, what would you like the insurance company to cover? The liabilities, maybe you would want in a TPD where you no longer can work, you'd want your mortgage paid off. Any future expenses, future education expenses of the kids, medical costs, and in life situation, the funeral costs. We also look at, well, what do you have in disposable assets? If you have an investment property, you might say, look, if really things got really tight, I'd sell the investment property, pay off the investment loan, and that part would be done. And continuing income, that could be either your income protection insurance continuing to pay you, or you might have passive income coming from investment property or something like that. So when we go through insurances with clients, we do like to look at, well, what is it that you would need? And I always like to balance it with the cost of the premium, because as I said before, insurance is not cheap, but you want to balance the cost versus the benefit, and so that you can kind of make informed decisions as to what timing. I'm always saying to clients, we always look at their insurances and whether we're not necessarily a new insurance company, because that is a little painful because they get you to do all the medical tests and everything, but more just adjusting how much cover have you got. As you get more financially comfortable, you may be willing to bring your cover down, what the insurance company is paying for, so that your insurance premiums come down as well. So something to think about on insurance, most people forget that when you've gone through all of this scenario, but it's really something to think about just to protect yourself, your comfort level, and know your situation. The other one, the other area I often find neglected a bit during the divorce phase. So actually this is where going to, and if you need, we can send out, I'll get Vivian to send out the link for the other presentation. If you are going through the divorce phase, do look at our tax webinar that I did do on that, and do speak to us about this, because there's some really great strategies if your partner's also not getting the best advice. I've had some really great wins with clients when we've been able to structure different aspects like super, and how they've actually received the financial settlements been split between both parties. So superannuation, and if you go back to the webinar I did in our first one, I like to look at super as being, if I look at my 3 buckets, it's, you know, the future, where that future is. That could be in a few years' time for you. It could be in 20 years' time. It's one of those assets that's going to end up potentially one of your biggest assets, and so many people don't look at it. So I like to have a look at it and actually work out how much do we keep looking at it? You know, if you've got 5 years till retirement, I want to have a really good look. If you've got 20 years to retirement, I still want to have a good look now and keep my eye on it, but the pressure is going to be less. When you're going through divorce and then post-divorce, you need to live for today, but not forget about tomorrow on your super. We don't want you getting to a situation where you're getting through, and I guess you've probably seen, many of you would have seen the stats of the number of women that get into retirement and are living at a very low, in a sense, poverty line and not having those assets. So even some of when I look at the financial settlements, I've had some really great, really exciting ones. I know I get really excited about it, but being able to say, well, here's the financial settlement coming. Let's go for X amount of your ex-husband's super. I want to build your super up to a minimum balance of this. So, and then also have so that you've got these funds in the house to live in, but I want to take some of his super rather than potentially some of the cash. So I'm working with a client now, about 55. So we're not far off retirement, and their super balance personally is quite low, because unfortunately with, you know, from a female perspective, we leave the workforce, and most women, our super balances are so much lower than men, that we leave the workforce having kids. The stats do show that a lot of us have been more lower paid than some of the men. So our super balances tend to be so much lower than men. So looking at what can I do as part of going through the divorce and then post-divorce, what can I do to help you build up your super so that when you retire, you've got a good super pension coming through and you get to enjoy those years of your life as well. It's just so critical, and it is something to think about. I know coming out of divorce will be a tough time at that, but it's something to not forget about. It may be something that we even say, look, we won't focus on super, we're aware of it, but we're not going to actively focus on it for 5 years, because 5 years, this next 5 years, you need to do these things, you know, depending on your age and family situation, etc. And then we'll start focusing on it, but never forget to focus on it. Once you get to age 60, and the reason why we love actually super, I'm a big fan of superannuation, is that once you're at 60 and your super fund goes into what we call pension phase, because you've gone out of your accumulation, any income that's earned on those investments in your super and it gets paid to you is completely tax-free. So there's also some really great strategies that I look at in maybe you make those extra super contributions as you're leading up to, and I did one of the other clients last week, we did one where we actually took some of the money that they got after financially modelled, they've got about 5-6 years till retirement. We're financially modelled that they're going to make maximum super contributions for the next few years until retirement. We're using funds as part of the divorce settlement to set aside to do that each year. And by doing that, I'm going to get her to a position where she's paying so much less in tax. We're putting it into super, and when she gets to retirement, she's going to have a decent amount to retire on and not have to worry about the age pension as well. So it's something that needs to be focused on and not forgotten with looking at that. So look, how much is it that you need? When do you want to finish work? When do you want to reduce current working hours? I often get that where we might do a scenario of what does it mean to my super if I reduce my hours from age, say 55, I reduce to 3 days a week instead of full time. What does that do to my super? How much do you want to retire on? And what are your goals at retirement? A lot of people say, I'd love to own my own home by retirement and then have X amount of income. So how much would you do? How much time will you need? How will you spend your time? Will you be wanting to do holidays, etc.? And then what are some of the long-term goals and are you on track? And some of those goals will be around, well, what else do you want to do maybe with your family as well? How do you want to help potentially your family once you've bounced back on your side? So something to really think about on the super, and don't forget some of those kind of aspects. Now, I just pulled some some data on what does it mean, like modest versus comfortable, and this is basically coming out of the ASFA retirement standard. They kind of the last data that they had on this is looking at the income needed, and I've compared it also there with the couple, but this is actually looking at being heavily, when you've got the income needed at retirement, 27,000, that's a super needed at retirement of 70. Now, what that means is that superannuation balance yourself of 70, plus you are reliant on the age pension at that point. In the other scenario where you have $545,000 at retirement, you at that stage you won't get much on the way of the age pension. At some other point you'll start to get a top up of it, and I financially model that. My goal is always to try and see what can we do to get you as a self-funded retiree to build your asset base up in your super, have it so you can draw down a pension, but that we've still got income generating on that. So also to potentially, whether it be leave an asset then potentially for the kids, or whether it is just keep building and being able to use up and do those extra nice holidays that you want to do. But it's being able to plan and give you those options and the choices as well from that perspective. And then another big one that I often see, and unfortunately I've seen it then actually playing through the courts when it hasn't been dealt with post-divorce, is really making sure that you have an up-to-date legal will, look at your superannuation and making a binding death benefit nomination or an SMSF will if you've got an SMSF, but making sure you have those in place now post-divorce so that you don't have a situation where, and I've seen this actually happen before, where the unfortunately the will in place and the assets are not going to where you actually would have hoped to have the assets to have gone to. And then looking at appointing an enduring power of attorney, who are you going to get to assist if something should happen to you, and who will that person be, and understand some of the tax implications for the beneficiary. So that's where we can really help. And if you do have a business, put in place a business succession plan as to what you've got. So really getting your estate planning and affairs up to date to make sure that you've got a plan around those areas as well. So I've really kind of, I guess, covered quite a bit in this area. So if I look, we've looked at your income, looked at your expenses, and looked at building that plan. The emergency fund, that's meant to be your safety blanket. And then looking at not forgetting insurance, your super and estate planning. Those three I constantly hear people forgetting. And again, if you are still going through the divorce stages and negotiating financial settlements, that's where getting some advice from an accountant, we can really come up with some really great strategies. And if your partner hasn't gone and got advice as well, sometimes I've had some really great outcomes, which has been really good. Just one a few weeks ago, extra 70-something thousand as part of the allocation of the estate, because there hadn't been a consideration of what the capital gains tax would have been. So they would have been out of pocket 70-something thousand had I not just looked at the proposed settlement and said, actually, hang on a minute, you're getting the investment asset and you're going to actually have capital gains inherited with that, and you'll be paying that later. So you can have some really quick wins, not bad in 1 hour, to have a look at it and then being able to turn that around. So as an advisor and accountant, we can help you with that. When life, would love to say it's a straight line. Clearly, it, as you're probably all experiencing, then it has many unforeseen changes. And so we just need to keep on track and looking at what we can do and dealing with those and really looking at how we can empower you. Because I guess when I go through a lot of, and those of you that are clients that have worked with me and gone through, is I kind of probably would say, yes, I'm an advisor, yes, I'm an accountant, but more so also an educator. Again, you're never going to love accounting as much as me, but I actually have a number of clients that say they kind of love it a little bit now as we go through the process, because the more you can understand, the more you're going to consciously and unconsciously make really good decisions for yourself from a financial perspective as well. So I'll open it up now to any questions anyone may have. We actually haven't had any questions come in yet, so maybe I've covered lots of the detail. But do we have any questions at all? If anyone's got any questions.
I guess one, Shannon, would be when would it be a good time for a client to come and see someone for advice, like when they're going through a divorce, like as they're going through it, at what stage would be the most helpful for them?
Yep. So yeah, that's a good one. So when to coming to advice, and this is where if I'm working with clients and you're saying, okay, I'm going through a divorce now, when should I now seek the advice? I usually the first meeting kind of, or the first part that we'd be working with you on would be on an accounting side and tax side, because I often say, well, look, until we know what your split of assets is going to be in your financial settlement, I can do some financial planning side with my other hat on, but I prefer to kind of hold off a little bit on that one and start to look at, from the accounting and tax, what can I help and strategize on that. But we will look a little bit at the financial side as it impacts super, as to whether, as part of the financial settlement, we want to grab more of the super, or is there a plan around that part of it? As we get closer to the financial settlement, that's where I usually have to pull together my advice on the financial planning side really quickly, because to give advice on super, we need to do a financial plan, and often we've only got a very short turnaround on that part. But it often will start on the accounting and tax side. But because I'm wearing both hats, and not everyone gets the I guess the privilege of being able to wear both hats, it means I can very quickly flip to be able to do that. So it's probably never too early, never too late in a sense, but I guess when you are going through that process, there could be just a few little things that, you know, when I can have a 1 hour meeting with a client, go through things, and then say, hey, I've just got you an extra 70-something thousand. I can tell you I've had a number of bunches of flowers with those scenarios, because I really enjoy that I can help make a change that if they had not got that advice, they would have been, $70,000 worse off. So
sorry, I've dropped out.
Yeah, that's okay. Yeah. Do we have any other questions? Any other questions? No. So our next two sessions, we have one that's come up, right? Let me just have a quick look. Yeah, would you recommend coming to see you for a 1 hour appointment when we have a proposed settlement? Absolutely. And getting the calculations behind that, especially if you have properties, investment properties and residential property, like your own personal home, and how that's being split. I can definitely help on that side, just to make sure, because some lawyers are good with some of the tax aspects. Now, you'll notice on every letter that you get from the lawyer related to your proposed settlement will say, we're not accountants, please speak to your accountant to be sure, etc., just the standard one. But I would suggest it because of the fact that they aren't accountants, and some of the lawyers are getting really good on the tax side to understand some of the aspects, but there may be some things that they can miss. So I work a lot with a number of lawyers that do send their people their way just to get that validation. So yeah, I can definitely to do that. Yeah. So that's good, no problem. Any other questions? No. So our next sessions, and then feel free to reach out with us some other ideas. I'm going to talk about, actually, it's one of my most favourite topics, which is supercharge your super on the 1st of June, and then talk about plan for a rich future. So any other topics that anyone has a suggestion, we don't have to stop at 4 if we want to go on to 5 or 6. But all of these topics have come about as a result of working with clients and seeing what are some of what I would say the themes of coming through, and where I could really help some of my clients in those areas, and get women to be going through and bouncing on the other side of that as well. As I mentioned before, we do have a number of webinars that we have done over the last few years. So if you go to our YouTube channel, Smart Business Solutions, you can like and subscribe, and you will get notification of new webinars that have gone up. There is the one also on divorce that I did record last year in January, which talked about some of the tax and accounting aspects as well. I think I've got another question. Someone's put their hand up. Let me just check how I do your hand up. Do you have a question? I think I got a message, someone put a hand up, but I can't see.
Sorry,
I can't see. Yeah, that's okay. Yeah, feel free to email me after, then feel free to email through to me if you do have any other questions, or and get in touch, and happy to help. The recording will be sent out. But thanks so much for joining us today, and I'll catch up with many of you soon. Thank you.